is a biggie. Popular Credit, it's pretty generous in its amount. And again, it's a refundable credit, so even if you have no tax liability, if you're entitled to the credit, you still get the funds back, right? So it was designed to, as they say here, alleviate the burden of certain additional taxes, such as gas taxes, Social Security taxes, Medicare taxes, all of that stuff that ordinarily you don't really get a credit for when we're calculating our income taxes. So, as I mentioned here, it's a refundable credit, so it's kind of treated like a payment that was made. Can result in a tax refund even if there's no tax liability. Now, there are pretty stringent requirements that have to be met. You can claim this credit even if you don't have a qualifying child, but the credit's going to be lower and your income has to be extremely low in order to claim that credit. Also, there are age restrictions as well. So that's like if you're over 65, you can't claim the credit. So that's to prevent like retirees. A lot of retirees have significant assets, but they really don't have any much income. And they've got, if they don't have other income and their Social Security benefits aren't taxable, it could look like on paper they really don't have resources, but they do have resources. It's just that it's not in the form of income. It prevents them from being able to take advantage of this particular credit. So it's the earned income credit, which means you have to have earned income. Earned income is any income that was subject to Social Security and Medicare tax. So self-employment income would be included, wages, tips, commissions, anything that was subject to those Social Security and Medicare taxes would be included. So, also, if there is a loss from self-employment tax, that reduces your earned income. Now, the earned income credit is kind of weird in that it works. So, most credits, what you see is as income goes up, the credit, it's kind of an inverse relationship, like the credit goes down, right? That's usually what you will see. With the earned income credit, though, it's kind of weird. There's a little bit of a curve to it. It goes up, starts at zero, if you've got zero income, and then the more income you receive, the more the credit, and then it levels off for a while, and then it starts to come down again. To the amount of the credit will come down. So there's kind of this sweet spot here where you maximize the amount of the credit. Because of that, there's actually an incentive to manufacture income that you don't actually have. So usually when we think of people cheating on their taxes, we think about them either increasing their expenses or decreasing their income fraudulently in order to reduce their taxes. But when we're talking about the earned income credit, one of the ways that fraud occurs with this credit is that people will manufacture income, maybe self-employed income. So they'll put something on there because, think about it, self-employed income, you're not necessarily always going to get a 1099 for that income. There are lots of ways that you can earn money and not have it really be reported. So, like if you're here on the income scale and this is your credit, you might have an incentive to try and boost that income to get to that maximum amount of credit. Yes, you're gonna probably pay more in Social Security, Medicare taxes, but if the credit itself nets you more, then you may have incentive to do that. So that's just one of the ways that that the earned income credit can be manipulated. One of the types of frauds that's seen. Also, the more dependents you have, up to 3 dependents, the higher your credit is going to be. So there are kind of 3 different credits here. So maybe we have no dependents. You're going to be like here, 1 dependent, dependents, gonna be like here, and then 3 dependents is the black. So it's gonna, your credit is gonna be, the more dependents you have, the greater your credit is gonna be. So another way that abuse occurs with this credit is manufacturing dependence as well. So they have some pretty strict, stringent requirements with regard to verification of eligibility. And this is one of those credits, like I said, as well, where the preparer themselves takes on responsibility and can be held liable for any fraud if they did not exercise due diligence in verifying that those dependents were eligible and that the income was valid. Okay, so what's a qualifying child? So taxpayer must either have a qualifying child or meet certain criteria. Qualifying child is one of the following. So son, daughter, grandchild, or a descendant, stepson, stepdaughter, or a descendant. Eligible foster child, they are defined as someone who the taxpayer cares for as their own and who is a brother, sister, stepbrother, or stepsister, a descendant, or a child placed with the taxpayer by a placement agency. So if you're a foster family and the child's been placed there, or an adopted child. Additionally, the child must live with the taxpayer in the U.S. for more than half of the year and be under the age of 19 or a full-time student under the age of 24, so that same dependency requirement. They have to be younger than the person claiming the child. So if it's that might be an issue, or if it's a brother or a sister, it has to be the younger brother or the sister. You cannot have filed a joint return except if you're doing it to claim a refund. And they have to have a valid social security number. If there is no qualifying child, all of these requirements have to be met. Your principal place of abode in the United States has to be in the United States for more than half of the year. You have to be older than 24 but younger than 65. So again, that older than 24, we're excluding the college age students here. The students who would ordinarily have maybe less income, but they're being supported by somebody else, right? So it weeds out the retirees. In the case of married individuals, at least one spouse must satisfy this requirement. So I guess you can have, if you got a spouse that's over 65, if the other one's under 65, then I guess you're all right. You cannot be claimed as a dependent of anybody else, and you cannot be a non-resident alien for any part of the tax year. All right, so the calculation. Questions so far about the qualifications? All right. So, you multiply the earned income, so you're only taking into account the earned income by a certain amount, up to a certain amount, by a percentage. When the earned income exceeds certain levels, the credit begins to phase out. Percentages for the credit and phase out amounts will vary depending upon the filing status and the number of qualifying children that were claimed. I'm going to show you a table here as to, well, actually the table we're going to go through the calculation, but there's also a table, which is the easiest way to do, obviously. But table appears, this one always, I trip up a little bit, so just kind of a heads up. I sometimes trip up in remembering how all of this goes. But so married taxpayers with 2 eligible children will use the 2 column. For earned income up to $16,510, the taxpayer is entitled to a credit of 40% of earned income. So in that case, in this example, that would be $6,604. The maximum earned income for a joint filer with 2 qualifying children. All right, so here's the table. So you look at, it's too big to get on here. How big, how much? I might have to make this a little bit smaller. Hold on. Get it all in there. So depending upon the number of dependents. So you can see if you have no dependents, 1 dependent, 2, 3 or more. So if you have 4, 5, 6, whatever, you're only allowed up to the 3. So the phase out starts at earned income of $9,800, or we'll just look at the none for right now. Phase out ends at earned income of $17,640. Oh, I'm sorry. So for joint filers, these are the phase out ranges between $16,370, $24,210. The maximum earned income credit for someone without any dependents is $600. The maximum earned income credit for someone with 3 or more dependents is $7,430. So it's a significant amount of money. We'll look at we'll use this chart to do some work on some problems. These are the percentages that were referred to up there. So here they've got married taxpayers with 2 eligible children would use 2 children, joint filers. So here's our phase outs. For earned income up to $16,510, so up to $16,510, you get a credit of 40% of earned income. So if they have $16,510 of earned income, you'd multiply that by 40%. Their credit would be $6,604, which is the maximum amount of credit that they would get. If it's an amount under that, if it's an amount over that, earned income over that amount, then this percentage gets reduced. And I'll show you how that works here in just a second. All right, so phase out starting point in this case starts at $28,120, that's that. Up to $28,120, they're entitled to the maximum credit. Once income rises above that, it's reduced by this percentage, by 21.06% of the amount over that, $28,120, until the earned income reaches $59,478, in which case they get no earned income credit. Okay, so this percentage here is the amount. You're going to use this percentage if the earned income is over, this amount. This is when the phase out starts. The $28,120, is that right? Yeah. Once it goes over that amount, then you're going to reduce the earned income credit by this percentage of the amount over this, until you get to this income level, $59,478, at which point the earned income credit is 0. All right, so let's take a look at how this would work. Oh, my arm is sore now. I'm lifting it up. All right, so we've got Danny and Wanda. They've got 2 eligible children and file a joint return. They're filing a joint return, so here's going to be their phase out. 2 children, so this column here, and these are our phase out ranges. They have earned income of $38,025. In this case, what we're going to do is we're going to have to take, so the maximum credit is $6,604, but we're going to have to reduce it by 21.06% of the income that exceeds this amount. So we've got to take, their income was $38,025 minus 28,120? $21,905 times 21 point, what's the percentage, 21.06? So 2086. We're going to subtract 2086 from here. $45.18. So let's do a different one. Let's make up some other stuff. Let's say we've got a single filer with one child, earned income is $25,000. All right, so what we're gonna do, so we're gonna use this column here. Take the maximum earned income credit, and then these are our ranges here. We're gonna take 15.98% of the amount over 21,560. We're gonna have to subtract that result from here. So what do we get here? 21,560. So 25,000 minus 21. $34.40 times 15.98%. Is that percentage right? $550 rounded. So we're going to subtract 550 from this. There's our earned income credit, $3,445. Let's do another one. So let's do a head of household with 3 children. Income is $42,724. Earned income, $42,724. This is a terrible marker. Hold on just a second. Got some more markers in there. If I remember right, I hoarded some. Something. Fingers crossed. No, that's dark, or that's light, I'm sorry. There we go. Oh, that's better. Okay, so 42,724 head of household. 3 children, we're gonna use this column here. All other filers, head of household is gonna land in there. So our maximum earned income credit is $74.30. And then we're gonna have to subtract 21.06% of the amount of earned income over 28,120. All right, so 42,724 minus 28, right? 28,120.
Wouldn't it be the other one since it's a whole household for all other fires?
Oh, you're right, I'm sorry, I got the wrong number there, thank you. Good catch. You're paying attention, 21,560. see everybody where I got it wrong? I used this number, this is for joint filers, everybody else down here, so this, 20, okay, so 42,724 minus 21,560. Ah, that's not right. 42,724 minus 21,560. 21,164 times 21.06%. $44.57. We're gonna subtract that. $29.73 is our earned income credit. Okay. Start the calculation with the maximum amount of the credit. Figure out the difference between the earned income and where the phase out starts, and then take this percentage of that number. If the earned income is over these amounts, there's not gonna be any credit. Wanna do another one? Okay, we'll do one more. Let's do, oh, this is hard to erase. My marker's good, but gotta use elbow grease now. So let's say we've got somebody who's single and they've got no children. And their earned income is $12,400 for their earned income. You can see as well that now there are some limitations on unearned income. They talk about that here. Disqualified income. So if they have earned income over $11,000, so these would be like, that would be like unearned income, dividends, interest, all of that stuff. Then rental income, royalty income, capital gains, that would make it disqualified. It's not earned income. And I mean, this isn't going to be included in this calculation, but once your other income exceeds that. Now, I don't, that's the air. I don't know about retirement income, if that's included in there. I really don't. Because I could see a situation where somebody's taking early retirement, they're 62, and they've got a nice pension. So they have, well, maybe they got a little job and they're a Walmart greeter or whatever, I don't know. They've got a little job on the side, so they've got some earned income. But they don't really need the earned income credit. If retirement income's not excluded, not disqualifying income, there could be situations where individuals who, even though their income is decent, they would still qualify for the earned income credit. But I don't know, they don't have retirement income listed there as an exclusion. Okay, let's get back to this, sorry. So 12,400, single, no children. So again, we're gonna start with the maximum earned income credit, 600. And then we're gonna take the amount of, let's just use this here. So 9,800 I'm subtract that from the earned income. So 2,600 times 7.65%. Whoops. 198.90, 199? Is that right? 199? Subtract the 199 from that. So we get $401 is the EIC that they would get. Okay? Questions? I'm going to show you the table here as well. Table 9. No, not that. There's a, where is it? Oh, Appendix A. There we go. Earned income credit table. So let's use this and see if we're right. So we've got filing status, single head of household, married filing jointly. Okay, you have how many, this is in your appendix, by the way, Appendix A. 0 dependents. We've got 12,400. Let's get up to the 12,400. 12,400. They've got 399. We've got 401. That's because this is a range. So just like when we're using the tax, the checks. If you, anytime you've got a range, you're not going to be exact. But $399, that's pretty darn close. So you can use this table as well, although your problems, make sure you do what your problems say to do with regard to calculating. They may want you to do it this way. What was I gonna say? Oh, I wanted to show you. So that chart that I put up here, you can see it in these numbers. So let's just focus on, so 3 individuals married filing jointly. So this is the income going up, and this is the earned income credit. So we're, going up. Here as well, still over here on this side for income, going up. And we're still going up. Over here too, still going up. We're in the 5,000s now. This is for the earned income credit amount. Still going up. 5,000s over here. 6,000s, 7,000s, 7,430. Okay. At this point, 16,500, we get to 7,430. Look, it's 7,430 for a while. 7,430. We're still at 7,430 in these income ranges. 7,430, 7,430. So this is the top of that table, not the table. What is it? Chart, graph. 7,430. Oh, here we go. Okay, so 7,430 stops at 28,150. Well, that's the same as the table that we saw. Now it starts to go down until ultimately it's going to reach 0. So if you're at, you've got $11,000 of earned income and you're at 5,209, you may have an incentive to find some additional income somewhere so that you can get up to, add another $5,000 of income, because then it increases your earned income credit. All right, I gotta get out of this. I just find that interesting, that it's, that one area where you actually may want to manufacture some income. Okay. Let's go to the form here. So here's the form that is filled out And of course, this goes through all of the calculations too, but the first part of this is just identifying information about the qualifying individual. So if you have 3 children, more than 3, it doesn't matter. Yes or no questions. Was he a child under the age of 24? Were they totally and permanently disabled? Child's relationship to you, remember that's important. Number of months the child lived with you, remember that's gotta be at least 6 months out of the year as well. But the calculation, they don't have the calculation on here. I don't know if the sheet where you actually do the calculation. Or maybe they're just using the table. But the earned income credit is gonna go on Schedule 3 under refundable credits. No, actually, it doesn't go on Schedule 3. It goes directly on the 1040. There's a line on the 1040, on the page 2 of the 1040 for the earned income credit amount. Okay. All right, questions? Like I said, this is the, as far as the chapter goes, this is probably the most complex area in the chapter of the credits.